Hello everyone. I have an example to kind of illustrate chapters 14 and 15 about corporations and partnerships and S corporations by utilizing basically the same information for an entity given three scenarios, whether it's a C corporation, the first one here on the left, an S corporation, the one in the middle, or a partnership, which includes, for federal tax purposes, LLCs, which are the most common form of business these days. Those come under, you actually can choose to be corporation or a partnership. Most of the time, they will be reported as a partnership, and so you use a 1065. So first of all, different forms, 1120 for the C corporation, 1120S for the S corporation, and a 1065 for the partnership. So each of these have revenue and regular expenses. So these are the normal business expenses. So literally these items are treated essentially the same under each. So from a general accounting standpoint, day-to-day debits and credit type accounting, you really don't make a lot of difference. It's not a lot of differences between the two or three entities in terms of that accounting, even for tax purposes. It's when we get into things that are different that you have to be concerned about it. Now, just a little bit about formation of each of these three. Typically, the tax law wants the formation of any entity to be tax-free, meaning that when you form or start a corporation or an S corporation or a partnership, that the general idea is for them to be that formation is not a taxable event. We don't want to cause a problem at the formation. However, the rules are much more strict about that happening with a corporation, and that includes C corporations and S corporations. Those that form it must control 80% of the stock after formation to ensure that the formation is not a taxable event. There's no gain recognized. A partnership can be, you can let anybody in later on, so forth. So the corporation's harder, especially if a shareholder joins later. They may not fit the 80% criteria and so forth. So it's a little easier, and you'll see in general, partnerships are more flexible. LLCs are more flexible than corporations in almost every aspect of accounting and taxation. So, got it formed, you've got some revenue, some expenses, really the same for all three. Now, looking at some what we would consider special items, and these are generally unusual for a typical business. So this is not something you run into every day, especially dividends. But you could have them, and it's common enough that we need to make sure we understand it. So dividends are different for each one. So for a C corporation, we have to know what percentage of the stock we own of the company that's paying us dividends. That is not an issue with an S corporation or a partnership. So for this C corporation, we own 50%. That means that we get a dividend received deduction of 65%. So when calculating the income for this C corporation, you always add in the full amount of the dividends, and then you take a dividend received deduction separate from your regular expenses, other deductions. And when you own 50%, that is 65%. Oops, if I can get the. So we would add in the 5,000 to the revenue and then subtract out dividends received deduction of 3,250. So the net result is the other 35% of the dividends is actually included in calculating our tax. So that's what's supposed to happen. You add in the dividends and then subtract out. That is not what happened. Now, if the situation is much closer to how much income we have. So in this case, we had with the 5,000, you would have had $25,000 of income with revenue minus expenses plus the dividends. And so the dividends is really not that close to the amount of income at that point. There's another restriction on the amount of the dividend received deduction. But it only comes into play when the amount of the dividends is close to the same as the amount of the income after regular expenses. For an S corporation, a partnership, these dividends, we don't care what percentage we own. They are simply a separately stated item. So what's going to happen on the return is we're going to combine these two and get an income of 20,000. And that's going to flow through to the shareholders on their K1 based on their percentage ownership. So whatever percentage ownership of the corporation they own is what percentage of that 20,000, and what percentage of these dividends, separately stated items, are going to be passed through. So they will report on their 1040 that percentage of the dividends. Now that will be calculated on their K1. They don't have to then turn around and calculate it again. They will have already calculated what percentage their ownership is. Now, same thing with a partnership, except partnerships can allocate that 20,000 and the dividends in a much more flexible way. It does not have to be exactly according to ownership. So two equal partners can agree to distribute the revenue, or the income or the dividends 80-20 if that's what they choose. That's acceptable under tax law as long as it's an agreement. In absence of an agreement to the contrary, then it will be distributed based on ownership percentage. But it is always done by ownership percentage in an S corporation. There's not the same flexibility. So charitable contributions are going to be, again, subtracted. Now, under a C corporation, they're limited to 10% of the income after the DRD. So you take 20,000, add the dividends, subtract the DRD. Okay, so you got 21,750, and so the charitable contribution 4,000 would be limited to 10% of that 21. So you would only be able to deduct 2175, okay? And the rest of it would be carried forward to future years, can only be used for the next 5 years, but would also be limited to 10% in those future years. The charitable contribution is not limited at the corporate level for the S corporation. So all 4,000 would be reported and divided amongst the shareholders according to their percentage. Charitable contributions for partners for the partnership based on the agreement if it's different than the ownership percentage. And then it's limited based on the individual shareholders or partners based on their AGI. Remember, there's limitations for itemized deductions way back in Chapter 5, specifically 60% of AGI for cash contributions and that sort of thing. And we'll assume these are cash. That means that the S corporation doesn't need to worry about limitation. The shareholder does, as does the partner in a partnership. So that's how charitable contributions are different. It's just limited on the C corporation. Capital gains are treated just like any other income under a C corporation, and capital losses can only be used to offset capital gains or carried back to do so or forward. So much more limited on the benefit of capital gains or even capital losses. Capital gains are just separately stated again for S corporations and for partnerships, meaning it will pass through on the K1 to the shareholders or partners. And then they will have to worry about whether, as a long-term, short-term, regular tax rate, capital gains rates based on their tax situation. So that's the important differences. So finally, you have in this situation the C corporation. We would calculate the taxable income by using this formula. And then calculate 21% of that. And actually, our charitable contributions might be a little higher because the capital gain, which should have been added in to calculate the limit on the charitable contribution. So we could do another $30 of charitable contributions. Not a big deal. So the calculation of all of these really doesn't mean that much for an S corporation, okay, or a partnership, because each piece is reported, not the whole thing, really. And the thing to remember is even if it is non-deductible, so for instance, if there's travel or entertainment, really not anymore, any entertainment expenses or meals that are limited, only 50%, if those are part of your separately stated items, both the deductible part and the non-deductible part of expenses reduces the basis of the individuals that own the shares or the partnership share. None of this affects the shareholders in a C corporation. Once they have bought in, they get dividends, and that's income depending on the earnings and profits of the business. They can put more money in, and that would increase their basis, that sort of thing. But how much income the corporation makes itself is what the corporation has to pay taxes on, not the shareholders. They are not concerned about that, except for from an investment standpoint, not from a tax standpoint. They're concerned about what dividends are paid. S corporation, the shareholder is concerned about all of the pieces in terms from a tax situation, because it's all going to flow through and affect their tax return, as with the partnership.